I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and chief market strategist Chris Verrone. Chris, how are you doing this morning?
I'm doing great, Ross. Thanks for having me.
Great to talk to you. A lot to get to. I want to start with something you've been noting in recent weeks, which is the resilience of the consumer stocks in
Mm.
the face of, what is a deteriorating, or at least the narrative of a deteriorating labor market. What are you seeing from the consumer stocks? What do you watch on that front? And then more broadly, how do you reconcile when the market is saying something different from the prevailing narrative?
Yeah, Ross, I think that's exactly right. This has been a very important call for us, really the last maybe 8, 9, 12 weeks, that consumer stocks in particular, things like home building and autos and retail, have really defied the consensus narrative out there. And I think the consensus narrative has been, okay, these tariffs, ultimately, they're going to hit the consumer, or weak payrolls. Look, they're reflecting this weakening of the consumer. We're just not seeing it in the actual stocks. And when it comes to heeding the market's message or heeding the message of the financial media, I'm always going to heed the market's message. And I think, in particular, when you see names and groups really defying what the narrative is out there, it tells you the market has something else on its mind. Consumer discretionary as a sector just made about 4-year relative performance highs versus the S&P itself, and that's equally weighted. So that's not just Amazon driving that. The average discretionary stock is acting very well. All these home building stocks have turned over the last couple of months. Again, I think that's reflective of, frankly, a pretty benign rate environment. Mortgage rates are falling, yeah, and even with all the attention on auto tariffs around the world, durables like autos are turning. They're turning here, they're turning in Japan, they're turning in Europe. So I like this message coming from the consumer stocks. I do think it suggests that the weak payroll data we got for the last 2 months is the old news, and the market's actually looking forward to Fed cuts and perhaps some reacceleration.
Well, let's talk a bit about the rate environment, because
Mm.
one of the things that I think is kind of critical to digest but hard is, when are rates going low for the
Mm.
right reasons and the wrong reasons, and when does that show up in equity market performance? What do you watch to gauge
Yeah.
that? And do you have any levels in mind on the 10-year?
So we say kind of half jokingly, half serious, but the US bond market is really the envy of the world when you look at where US 30-year yields are, low end of the range relative to where German 30s have been, and French 30s and Japanese 30s. There is just a persistent bid to US Treasuries here. And I think ultimately it's a message that the fiscal backdrop is probably better year over year than many expected. When I look at kind of the curve here, 10-year yields in particular, below 420, I think that's pretty meaningful. But you raise a good point. There's probably a fine line between, when do lower rates really stimulate things, and then at what level do lower rates actually stop being stimulative and suggest there's a real weakening of the economy underway? I think the key to answer that question is when lower rates start to be accompanied with defensive leadership. So not discretionary working, but staples working. And we haven't seen that yet. There's really no realm of life from staples. They made new lows yesterday. I also think, kind of just importantly in terms of levels, 385 on the 10 was the low around the tariff stress in early April. I think you'll probably keep tens above that. The real kind of pressure on rates on the downside we see is still on the short end. I don't think it's out of the question. You get to something like 3, maybe 310 on the 2-year yield. We're 350 right now. So the market's saying, with a Fed funds rate about 4.5, the market wants 3 or 4 cuts over the next 4 or 5 meetings.
Yeah, and that's a high bar to clear. We had some inflation data this morning. We're recording on
Mm.
Thursday that wasn't totally benign, so something for the Fed to keep back in mind. All right, market at all-time highs. We're in this kind of seasonally weak period. I'm going to give you one of three things to kind of expand on: valuation, seasonality, sentiment. What is the biggest kind
Mm.
of risk to your mind of those three? How do you think about it as we head towards the end of the year here?
So let's talk about sentiment. As we kind of close the book on the summer, we look to the fall. I think really since April, certainly since May, as the market began to rally, there was almost a disbelief out there. how could the market be up given what the geopolitical and the policy and the fiscal framework look like? And I get that. But we're 35% off the lows. And I think what you've begun to see over recent weeks is confirmation that the undefeated rule of Wall Street is alive and well. And the undefeated rule of Wall Street is attitudes will always follow price. So you're starting to see that bubbling of attitudes and animal spirits and sentiment that I think will begin to pose a risk at some point down the road. I don't think we're quite there yet in terms of the speculative fever being so egregious. But we're starting to see in our work some of our sentiment indicators begin to flash, not red, but beginning to flash more yellow. And what that means for us is very simply, Ross, that the bar is being raised higher for the market to keep overcoming the expectations of the consensus. I think we ought to be aware of that as we move into the fall and into the winter. My suspicion is this becomes a bigger deal the closer the market gets to 7,000 on the S&P. I think that's a later fourth quarter into 2026 story. But you raise a good point. Between valuation, between seasonality, which I'm frankly less concerned about, and then sentiment, I would start to raise my alarm or guard a little bit on what the sentiment or how the sentiment data evolves over coming weeks and coming months.
Chris, as always, super insightful. Thank you so much for the time, and we'll look forward to talking again soon.
My pleasure, Ross. Thanks for having me.